I'm Nick Elder with Ironton Capital, and I'm joined here by Joe Massey. Yeah, we got a lot of wild things happening in the landscape today, so we're excited to dive into this. Cool. Quick note from our attorney here. Obviously, this is not going to be an offering of any type of investment opportunity. This is a real estate trends call, but you may hear some things like project, will, should, expect. You'll also see towards the end of the presentation just a quick overview of Ironton Capital's funds, both our growth opportunities and income opportunities. So that's why we're disclosing this note from our attorney here, but I won't go into too much detail. You're welcome to read through that as you see fit. Let's see, Joe, you want me to turn it over to you?
Yeah, man, if you're ready, if you want to put us in full screen so everybody can see everything.
Yep.
So let's just start with the summary points. We're getting close to the end of first quarter already. So number one, good news, prices are up slightly in 23 and slightly in 24. We're going to talk more about, trends for what we're seeing for appreciation, but I do think prices will be up slightly in 25 as well, with a couple of caveats that we're going to talk about. We're seeing that buyers are finally more likely to say, all right, I do want to buy. For a number of years there, I was talking to people and they're saying, well, I'm waiting for rates to come back down. I'm waiting for 3% rates again. I'm waiting for 2%. Well, they're starting to see that 7%, 6.5%, that's actually normal. I don't even say any more of the new normal because it's not new anymore. That is a pretty normal and appropriate interest rate if you look back historically. We're also seeing sellers that are saying, yes, now is the time to sell. Nick, I know you've got a lot of clients and I've got a lot of clients that have 3% interest rates. And you hear this phrase all the time. I have a 3% interest rate. I'm never selling my house. Have you ever heard somebody say that, Nick?
Yeah, absolutely.
Yeah.
Myself included.
Yeah. The reality is that is not a forever statement. That statement is actually, I'm never going to sell until something changes. We see that life goes on. People get married, people get divorced, people have babies, people have job relocations, people get sick. So even a lot of folks that have 3% interest rates, life goes on and they do still have to sell. Inventory is building, so it's less of a seller's market right now than it has been in recent years. In fact, we're seeing that some neighborhoods are actually a buyer's market. Now, to talk about interest rates a little bit, and we're going to dive into this as we go along, rates have improved from the 8% that we saw in late 2023, but affordability, particularly for first-time homebuyers, is the primary challenge. And rates might get a little bit better over the coming second, third, fourth quarter. But if you've got clients or if you're a client yourself thinking about buying and you're waiting for a 4% rate or 5% rate, that's not going to happen. And we're going to dive into that. So our outlook, we think that home prices are going to be up 1 to 3% as compared to the first quarter of last year. Now, condo prices, and this is what I was saying, we expect prices to go up with a caveat. We are seeing some softening in the condo market. The biggest reason, HOA dues and homeowners insurance. Those are both getting more and more expensive. It seems like every day, but that's leading to a little bit of softening in condo prices. And we think that volume, number of transactions in 2025 is going to be up about 5% from 2024. Condo volume is our projection going to be down for all the reasons that I just mentioned. So if you're a first-time buyer or you have clients who are a first-time buyer, number one, buy as soon as possible, all right? And then refinance whenever you can in the future. Here's why. The number of buyers is going to grow much faster than the number of sellers whenever interest rates do drop. And that's going to lead to everything that we saw in 20, 21, 22, which is a massive frenzy of people buying properties. So right now, if you're a buyer, you have choices. You can sleep overnight and decide if this is the right property. Yes, I understand rates are 6.5, 6.7, 7%, but you can buy the house today, probably get seller concessions or a price reduction, and then whenever interest rates go down, you already have the home and you're not going to have to compete for it, and you can then refinance. And if you work with me, your clients can refinance for free. We offer a voucher that they can refinance at any point in the future whenever interest rates go down. Now, if you're a trade-up buyer, you have an average to nice home, you want to buy now for the exact same reasons. But really importantly, make sure your home is parade ready. What do we mean by that? Make sure you've done all the deferred maintenance. Make sure that you can pass an inspection. Make sure it's clean, good photos. Gone are the days of just taking iPhone photos, throwing something up on the market and getting 10 offers or 12 offers. Right now, your property does need to be priced appropriately and parade ready for sale. Now, if you're an owner-occupant seller and you're not buying, I hate to give this advice, but I will. Wait. When interest rates go down, you're going to see that demand is going to increase faster than supply, and your market power is going to increase. And then if you're a trade-up buyer with a below-average house, you want to wait for the same reasons. A subpar home is not going to sell very easily in today's market, and you've got a lot of fussy buyers out there. However, if you do have a below-average home and you need to sell it, right now is a great time to sell it. So the spring selling season begins on February 15th. So we are into the spring selling season. We're about a month into it right now. And Nick, let me phrase this as a question. Have you heard of any competing offers lately? Any listings getting 2, 3, 4 offers? Have you heard of that lately?
No, in fact, zero number of times I've heard that as of late.
Okay. I've actually had 4. I've had four of my buyers. 3 did win against multiple offers and 1 did not against multiple offers.
Wow.
And this is all within the last 15 days.
That's amazing. I'm guessing these were in, some of the higher demand, really good location areas. Is that?
One was Westminster, one was Denver proper, and one was in Highlands Ranch. And then the one where the buyer lost out was in Thornton, of all places.
Wow. Okay.
Yeah.
Well, that's good to hear. That's encouraging.
Yep. And if you're an investor buyer, buy now, focus on a detached single family home and refinance later. If you've got a 1031 and you're trading up, buy now for all of those same reasons. So we talk about it a lot. Buying now allows you to secure the price of the property, right? Because you can only negotiate on the price one time, and that's on the day that you close or the day you go under contract. But you can renegotiate on the interest rate as often as you want. What I mean by that is you can refinance as rates come down. You can refinance at any point. But what if rates go up? You don't have to refinance, right? You can be locked into that 30-year fixed rate and you've negotiated a great price on the property. You can always refinance later. So that's why we still give out that advice. If you're buying, now is a really, really good time to buy. Anything you disagree with that on that, Nick?
Definitely not disagree. I was actually just reading an article about 20 minutes ago that was stating really what the Fed is likely to do over the coming months. And it was really interesting because, you mentioned here that rates may improve 25 to 50 basis points over the quarter. I think what we'll likely see, a lot of people were saying in 2024, we just got to survive until 25. Everybody thought rates were going to come down and then the whole, everything would turn around like magic. But now everybody's saying persist until 26. The rates are not going to save people. And, a lot of this is coming from my background and knowledge on the commercial side, right? So this isn't necessarily applicable to everybody who's buying maybe a primary or a residential, single family rental. But back to like what the Fed said, I really want to, reiterate that it's unlikely that rates will significantly improve this year. Unless we go into a deep recession out of nowhere with the new administration, who knows? But the Fed's been they've been very vocal. I think, with this month, the probability of them cutting interest rates has been lowered to 1%. When May rolls around, it's gone from 45 to 22% likelihood of them cutting rates. Yep. So we're unlikely to see the Fed make any meaningful decision in this market of volatility and uncertainty. And for that reason, rates will likely remain persistently high. And this is just a market that we're going to have to operate in for 2025, in my opinion.
Yeah, I like that. Persist until 26. I think that I didn't have a good tagline for anything that would rhyme with 6. So I got to see it.
It's cycling around LinkedIn now. I don't know what 2027 will be. I can't find something that rhymes right now with 2027, but we'll learn come December if we're still in the same position.
Yeah, I agree 100%. The Federal Reserve is meeting tomorrow for their updated announcement on the Fed funds interest rate. And I think you said 1%, my opinion. Yep. 0% that they're going to decrease interest rates, short rates tomorrow.
I guess they wanted to maintain some level of optimism, no matter how low 1% is. But, you say 0%, 27, hell or heaven.
Right.
That
I like that,
Janet. That could be a good one. It will certainly, if we're in this position come 2027, it will certainly be hell for a lot of people, I think.
So let's talk about some key questions. I get this question every single day, multiple times a day. When are interest rates going to come down, or when are mortgage rates going to come down? And we're going to talk about this. A lot of the economists are expecting rates to drop anywhere from 0.75 to 1.25 point in 2025. I disagree with that. And I actually have a degree in economics, but I don't work for a Morgan Stanley or a Chase or Bank of America and have all this data and graphs and all sorts of stuff. But I disagree with that. And I think if Lon were here, I think he would say the same. We expect pretty small declines, maybe 1/4, maybe 0.5%. Again, if I'm wrong, I'll be thrilled. If rates go down by 1.25 and we have, a ton of buyers coming to the market, nothing would make me happier, but I don't see that that's going to happen. What is it going to take for prices to come down? Well, condos, we touched on, you're going to probably see some softening in the condo market. You might see 2 to 4% decreases. Homes are probably going to be up 1 to 3%. The average that all the experts are predicting is the market will be up roughly 2.5%. I love this one. Will I be able to find a home if I move? Yes. All right. So this goes back to inventories are at the highest levels in the last 4 years. And back to what we were talking about, competing offers. Let me phrase this as a question, Nick. Have you heard of any contingent buyers getting under contract lately? Meaning I have a house that I got to sell. I don't have it under contract yet, but I want to put an offer in on this house contingent upon my departing residents selling. Have you heard of anybody getting that done lately?
Personally, I haven't, but I think you're going to tell me the answer might be yes.
Yeah, I have 3 right now. Yeah, I've got a guy who's under contract on a 60-day contract. He got under contract on the new house before listing his old home. He lives in Austin, Texas. He does have his home listed now, but it took about a week. So he was under contract on the new property to buy, then worked through the listing process. Now that property's on the market, and the seller was more than happy to accept his offer. So we are seeing contingent sales, which answer that question. Will I be able to find a home if I decide to sell? Yes, absolutely.
Yep.
Will the housing market pick up next year? And so this really is a question about transaction count. I'm going to disagree with some of the experts again on this one. They're saying a 15% increase in sales count. I don't see it. I think home sales are going to increase between 4 and 6% as compared to last year. And last year was the worst year for transaction volume since 1995. So think about that. Over the last 30 years, there were fewer transactions than at any point since 1995. So last year was a rough year. If you're a real estate agent on the call, you might have had a tough year. That's why. There was just less activity going on. And then my favorite, is the market going to crash? No. So unlike 2008, 2009, almost everybody has a ton of equity in their home. And we're going to touch on delinquencies, but foreclosures are very, very unlikely in the current environment. So let's talk a little bit about consumer confidence. All right. So consumer expectations have really soured after discussions of tariffs, all sorts of things. The stock market, I don't think we have anything here about the stock market, but it's down 9%, 10%, depending on which metric you're looking at. That's going to lead consumer sentiment down this, I don't want to say cliff, but down this steep incline here, which is what you see on the far right. And consumers have really grown pessimistic about the market for selling a home. All right. Now, despite that, we are still seeing plenty of new listings and inventories are growing. And what this leads us to believe is some of the new listings are not elective sellers. What do we mean by elective sellers? An elective seller is somebody that says, I like my house, but I would really like a bigger backyard. I'd really like a better kitchen, right? And so those people don't have to move, but they're choosing to move. So that would be an elective seller. A non-elective seller is somebody who's getting divorced, somebody who's maybe getting married, having a baby, and they need more space. Somebody who's maybe getting relocated for a job. And so we're seeing a lot of listings come on the market for reasons that have always grown listings, which is life goes on, right? Births, deaths, divorce. That's what we're seeing a lot of sellers, or what's leading to a lot of the increased inventory. And inflation worries are the biggest cause, right? A lot of people are worried about inflation. You see on that chart on the left, there's a lot of people concerned that inflation is going to rear its ugly head again. Now, it has been improving recently. Is this going to trickle over to consumer confidence? That remains to be seen. There's a lot that happens in the media. There's a lot of stuff on social media, and that just is leading towards lower consumer confidence. And we'll see, if folks really understand inflation, that it's coming down and that it might be a good time. That's going to be interesting to see with consumer confidence. And the potential number of movers has increased, but this is really interesting. On the right-hand side, the potential number of movers that say they would prefer to rent is at a high for the last 15 years. That's on the far right-hand side of that right chart. That a lot of people that have to move are saying, well, I'm just going to go ahead and rent because that's preferred to buying right now. Now, the number of sales, we touched on this. We do expect it to increase. I disagree with this. I don't think we're going to have 5.1 million sales. I think we're going to be closer to, 4.5, 4.4 million sales. One important point too, 2024, where it says 4.6 million sales. This was a projection, and that number actually did finally come in at 4.01 million sales.
So
just
wow.
Sales. So if we're up to 4.2, 4.4 million sales, this year's actually going to feel a lot better than it's going to feel somewhat better than last year. All right. The movement to buy more homes might not be broad-based due to affordability challenges. And this is one of my favorite slides here on the far right. Affordability is a big, big problem. We've seen an increase in home prices, increase in interest rates, increase in taxes, increase in insurance, and increase in HOA dues. The cost of owning a home is up in all 5 metrics that impact that monthly payment. Guess what is not keeping up with that? Wage growth. And I think we have another slide for this. But affordability is a real challenge, particularly for first-time buyers. And this is leading to buyer traffic being soft. All right. So this is talking about new homes, not resale homes. But you do see that builders are very pessimistic on that left-hand slide. And then on the right-hand side, right-hand slide, you've got the inventory of homes that are just sitting on the market at new builds is higher than it's been in the last 15, 16 years. So if you have somebody that is maybe a fussy buyer and they don't like a resale home, take them to a new build development. That could be a really good opportunity for them to get some good deals. And I'll give you another example. I had a client just recently, Nick, you're going to love this. They were buying a new build in Summit County, and the mountains is always competitive. It was an $850,000 purchase price. They got $62,000 in seller concessions that we used to buy down their interest rate. We gave them a 2-1 buy down. Their fixed interest rate with that seller concessions was like 5.5%. And it was a new build that should just fly off the market, right? So if you've got buyers that are thinking about buying and they can't find what they want in a resale home, take them to some new build developments. There might be opportunities there. All right, we spoke about renters or pessimistic consumer confidence. This chart I really like. This is the percentage of consumers with an unpaid bill in the prior month. So the red is homeowners, the gray is renters. Look at this. Renters, greater than 25% had at least one bill that they did not pay last month. That's kind of scary. But I want to bring your attention to the very center of the chart where it says rent or mortgage, that red line. Less than 1% of homeowners had their mortgage that they did not pay last month. And I see our good friend, Mr. Lon Welsh, joining us. Lon, you get settled in. I'll keep going for a couple minutes. Then we'll turn it over to you. That way you've got time to make sure everything's working.
Okay, great.
Now, this one I thought was interesting. The number of people that plan to buy a home in the next 12 months is actually higher than what we've seen in recent years, which I think is really, really good for all of us here on the call. And this is one of my favorite charts. I'm always grateful when Lon updates this. Credit cards. Credit card balances are at an all-time high, which is that gray line you see over the far right. There is greater than $1 trillion of credit card debt currently. This is how many consumers are keeping up with inflation, is by financing it. This is how they're keeping up with the cost of eggs, the cost of gas going up. All right. It's because of people using their credit cards. Now we've
talked back to that, Joe.
Yeah.
Wouldn't it be kind of historically odd that the amount of credit card debt would like more than double from 400 million to over $1 trillion in just the space of like 6 years?
That is historically very odd. Yes. You see a big spike in 2009 and 10 after the global financial crisis. I don't know that I actually agree with that big spike kind of there in the middle of the chart. I think that the line to the far left may have been underreported. So I'm not sure that it truly went up that much. I think the line on the left should actually be moved up a couple of bars. But you're exactly right. Seeing it go from 400 million to over 400 billion to over $1 trillion in 15 years, that is a staggering amount of people that are financing stuff.
I think there's a psychological factor here at play too. If we look back to like the early 2000s, like you used to have to actually get in a car, go to the store, go buy something. It's a process. Now I can scan my face. I don't even have to click a button and I can order something on Amazon. Yep. I mean, people are, at the end of the day, like the ability to purchase something there's no friction.
That's right.
No friction. And I think that, there's also that reality of how simple it is now to actually purchase something online. I can go to Amazon and scan my palm and buy my groceries, or not Amazon, sorry, Whole Foods. I don't even take out my credit card. So it almost feels like I'm never even buying anything. You know what I mean? And so I think there's also that reality, like that we live in this like global marketplace where everything is so much easier to buy. And obviously inflation's making things worse. Eggs cost $12 for a dozen now. So Mark said I'm fading out. Can everybody else hear me?
I can hear you just fine. Yeah, I think you're good.
Might be, maybe could be your Wi-Fi, Mark. But if I'm fading out, please let me know, guys. I wanted to add that in there because I think it's also an important point to make. And I do think credit card debt will continue to grow at a very rapid pace if we continue at this trajectory, in my opinion.
I agree 100%. I think there will eventually, the Bank of America's, the Chases, the Capital Ones, they're going to have to start putting some restrictions on how much they're letting people increase their limit. And that's going to lead to you either have to sell, you have to declare bankruptcy, you have to take out a second mortgage, or you have to refinance. Any one of those four options works in our industry. So while I hate to be negative about people taking out credit card debt, for those of us on the call, this chart is actually really positive if you step back and see what it's going to do for our business.
Yep.
All right. So we've spoken about this. Why is it important to buy real estate? If you are working with any first-time home buyers, show them this chart. First-time home buyers are at the lowest percentage of the market I think that it's ever been. I think first-time home buyers last year accounted for 28% of the market, which is historically low. I think it's our job to show this slide to first-time home buyers and say, hey, if you rent for the next 10, 12, 15 years, your net worth might go up from $5,000 to $10,000. But if you buy, your net worth is likely to go up from $187,000 to over $400,000. So this is a really, really powerful chart, one that I focus on a lot when I'm speaking with first-time buyers.
Love it.
And long-term investment, I love that cryptocurrency has made it here, that there's 3% of the United States that thinks that cryptocurrency is the best long-term investment. I think the three of us on this call are over in the camp on the left. Real estate is still the best long-term investment. So make sure you share this with your first-time buyers as well. So let's kind of move along here. So Lon, now that you're here, tell us who you are.
Yeah, I'm Lon Welsh. I started a real estate brokerage called Your Castle Real Estate about 20 years ago and grew that to be the largest independent in Colorado, just under 800 agents. So we do, 3,000-4,000 transactions a year. And I also started a company called Ironton Capital, which helps people invest in real estate, but do it in a passive format versus having to be an active landlord. So excited to be with you guys. I apologize. I was driving from Vail to Steamboat in a blizzard. So it's crawling along instead of my usual speed. So I'm sorry that I'm late.
That's all right. We'll just write this down as your one tardy for the semester. That's no problem.
I've been on rabbit ears past during a blizzard as well. So I know what that feels like.
30 miles an hour feels very fast.
Yeah. So Lon, do you want to take over here for a little bit and talk about whether or not prices will drop?
Yeah, let's talk about that. So first, let me give you some context. I think that it's a mixed bag on prices, and we'll explore that in a little bit more depth. But in the long run, real estate always does really well. So this chart shows you the average home price by state from 1991 to current, and you can see the average for the U.S. is 300%. So certainly there were some down years in there, 2007, 2008, most particularly. But overall, real estate does really well in the long haul. Even if you were in the worst state, Illinois, you still got 177%, which is pretty darn good. The three best states are Montana, Utah, and Colorado. So if you're based here, congratulations, you won the jackpot. What does that mean specifically? So the average home price in Denver in I think I clocked this to 1991 just to do like a 25-year period, so it would match up, 35-year period, I'm sorry, so it would match this chart. The average home price in Colorado then was about 125 grand. And you can see how that has changed. Currently now in Denver, it's a little bit over 700. So what if you put 25% down way back in 1991? If you look on the chart on the right-hand side, the Colorado home equity would have grown from your $25,000 down payment to where you'd now have just over $600,000 of equity. So that's just a gigantic return. If you look at the stock market, that's in the solid green line. 25,000 invested in 1991 in the stock market would now be worth 300,000. So nothing wrong with the stock market. Also a great choice. The dashed line is the average overall for the United States. So the average home price with a 25% down over the long haul historically is very close to the stock market, but it's a lot more fun to live in the house as opposed to just have some abstract piece of paper from Fidelity once a quarter.
Absolutely.
So I always want to give the context that real estate in the long haul does really well. What's going to happen in the near term? I expect that over the next couple of years, you're going to see that the rate of appreciation is going to be a lot less than it has been historically across all of the U.S. and certainly in Colorado as well. I do think you'll see houses continue to go up at about the rate of inflation, so maybe 2 or 3% a year, but not the 6 or 6.5% that we've enjoyed. We have seen that attached homes, condos in particular, have been going down at a very, very slow rate over the last, say, 18 months. And that's probably going to continue for a little while as well. So if you're thinking I'm going to just wait on the sidelines and wait for a better deal for houses, I don't think that's likely to be a good strategy. For condos, maybe it is. You'll have to outweigh, if I could save 1% or 2% per year off the price of the condo I want versus the headache of having to wait. Is that a good trade-off or not? You and your family can certainly think through that. So this is just a really fun chart. People will often ask me, so all these people who are moving from Colorado, where do they move to? I don't know the answer to that question, but I can tell you for these other 6 states, these are the 6 states that lose the most people, and we're not one of the top 6. Usually they move just barely over the border, not that far away. Very interesting chart. Illinois really stands out, like just this, the middle of the donut, Wisconsin, Iowa, Illinois.
Yep.
So if you ask the experts, what are we going to see for home price appreciation this year? The consensus view is about 2.7, 2.9%. We'll see. I think that's probably pretty close. Denver will probably be a little less than that.
I agree with that.
So if you take a look from 2019 to current, you can see that we had some really aggressive home price appreciation just after the initial spike of COVID, and that things have gotten back down to normal now. But I think overall that pricing is going to kind of limit how much people can afford to pay, and that you shouldn't expect a ton of appreciation for a bit.
Can we pause on that chart just for one moment, Mark? So one comment that I hear from folks on a pretty regular basis is, I'm going to buy once prices go down. Once prices go down, that's when I'm going to buy. And if you look at May of 2023 and like April of 2023, there's 2 tiny little red bars. When folks say, hey, I'm going to wait for prices to come down, they already did. It was in April,
you missed it.
You missed it. Prices are on their way back up. So for folks that maybe have first-time buyers that really want to time the market, it's too late. You missed that window. The last time prices went down was in 2008 and 9. So I don't think we're going to see a crash, and I think we've got some more slides on that. But this is one that I like to share with folks when they say, I'm waiting for prices to come down. They already did. It's too late. They're on their way back up.
It's a really good point. I know. Go ahead.
No, I was gonna say, if you're in this for 15 to 20 years, there's really no sense. We can never know the bottom of the market, right, until we look back. Exactly like this situation. In May 23, we did not know we were at the bottom of the market. looking at this graph, now we know where the bottom of the market was. But this goes back to that graph for what did real estate do in Colorado over a 25, 30-year time period? It grew 600%. That might be a little bit smaller maybe over the next 25 to 30 years. But if you've got a long time horizon, that's like whether you're in the stock market, real estate market, if you're on a 10, 15, 20-year time horizon, whether you bought today or last year likely has very little influence or meaning in the long run over a couple decades.
Mm-hmm.
Yeah, I would wager you a cup of coffee in Colorado over the next 35 years. It's not going to look like on the right hand side here. It's not going to be the bar at the top. It's going to be the line that's on the bottom for the overall U.S. average. And I think the stock market, there's no reason to think that it's going to be really that much different over the next 35 years. So if you said, do you think it's reasonable to expect that my equity down payment in a house I bought today in Colorado will generally match the stock market in performance? I'd say absolutely. I'd be shocked if it didn't. I don't expect the big line, but.
And here's the cool thing. If you buy that house, you get to live in it, right?
You
get to have
you
shelter.
get to enjoy it every day.
Right, exactly.
It's a wonderful thing to have a house. Joe, can you talk about this one, debt to income, and why it matters during the loan application process?
Yeah, so we touched on this a little bit earlier about affordability. If you look there at January of 2013, right in the middle of the chart, this is when affordability was at an all-time high. Now, I understand it's at the lowest point in the chart, but what this is indicating is how much of the population's income is necessary to make the payment on a new property when you factor in interest rates, taxes, insurance, wages, and home price. So January of 2013, that was when homes were the cheapest from a monthly standpoint as they've been in the last 20 years. Now, over on the right, when interest rates were really low, January of 2021, you saw that it was very close, that the population was spending roughly 13% of their income for their housing costs. And now on the far right, it's up to 27%. That is how much folks are spending from their wages in order to afford housing. And that's the highest it's been, I don't know how far back this goes, since 2000. So that's the highest in the last 25 years. So if you have buyers that are saying, man, it's so expensive to buy a home, they're not wrong. They're having to spend a higher percentage of their wages to buy a property. And this is where you want to exercise caution, but also point out home prices are likely to continue to go up. This might be worse in the future. And when rates come down, you can always refinance to bring that blue line back down. So I do still think it's a good time to buy, even with challenges in affordability. Just don't overbuy. Don't buy too much. That's going to stretch your monthly budget.
Right. That's really, really good advice all the way around. I love this chart because when I talk about why I don't think that prices are going to appreciate very much is because people can't afford to. And this chart does more to convey that than really any other chart I've got in this 120 pages or whatever I've got here.
I agree.
Is there going to be a foreclosure boom? I'll just really tell you quickly on this. No possibility.
No.
So the chart on your left shows you the number of trillions of dollars of home equity in all of the residential homes in America. It's just over $30 trillion. And the amount of collective debt, the mortgages against all of those, is just over 13. So there's 17, 18 trillion of equity. To my astonishment, 39% of American households have no mortgage at all. So Joe, I don't know what you screwed up, but you need to make more mortgages, clearly.
Yeah, I got to call these people.
You need to go buy a boat. You need a loan.
Yeah.
And another 29% of the people have got more than 50% equity in their property. So the number of people who have a loan with less than 50% equity, which isn't really all that aggressive by any means, is only a third of the people who are homeowners. So the amount of equity out there is just astonishing. So the last time we really had a big problem with housing was 2007, 8, and 9 during the great financial crisis. And if you take a look in this chart at, say, 2010, you can see that the cumulative debt of all the mortgages was more than the value of all the homes in America. So it's not a big surprise that when someone lost their job and they didn't have any reserves to make the monthly payment, the odds were very high their house would be underwater. And that's why we had so many foreclosures. We're in the polar opposite situation right now.
That's right.
So I'll just do the one slide on why there's not going to be any foreclosures. I think that does it pretty well.
Yeah.
So will the rates go up or down? Boy, that's a great question. So lately they've been on sort of a downward trend, right? We're down about 0.5 point since the beginning of the year.
Yeah, right around what's the average say? 6.7%, which, oh yeah, it's right there on the slide on the left-hand side of the chart. Yeah, 6.7% as of today.
That's fantastic. So rates have improved a lot. Unfortunately, they're improving for bad reasons. The rate is comprised of the 10-year treasury. So when the government borrows money for 10 years, that's the note they use to borrow it from the markets. And it's the most liquid financial instrument on the planet by a long shot. And then you add a risk premium on top of that, because mortgages are more risky than a government debt that has no chance of default. So the chart on the right-hand side shows you the risk premium. So you can see during 2000, 2001, the very first part of 2002, the risk premium was really low. The reason why that happened is the Federal Reserve was concerned about the initial stages of COVID damaging the economy, and they flooded the economy with dollars, something they called quantitative easing. So what they did is when you get a new mortgage from Joe, he'll take that with, say, 1,000 other mortgages that are very similar and rubber band them together, and they'll slice them into pieces called tranches. And then they sell those on the market to buyers. And those are called mortgage-backed securities. So when the government was trying to stabilize the market, what they did is they bought, was it 4 trillion of MBS?
I think that's right.
3-4 trillion. It's some incomprehensibly huge number. The government bought these mortgage-backed securities to bring down the average mortgage rate to stimulate the economy. And it worked extremely well.
It was great. It worked.
Yeah. So if you remember a couple slides back, we talked about the average price change by month. So you see like these 20% price changes that we've got there. That's from like January, let's say July of 21 through the very first part of 22. So if you take a look when the quantitative easing was active by the Fed, you're going to find it's no particular coincidence if you take a look at the right-hand side of this chart between 2020 and 2021, or 2022, I'm sorry, rather. That's when the Fed was buying all the mortgage-backed securities. And since there was so much demand, they only had to offer a very tiny amount of interest on a mortgage to attract a buyer, because it was usually the US government. And they were able to pass that savings on to the home buyer. So if you got a 3% mortgage in 2022, or you did a refinance into a 3% mortgage, that's why, because of quantitative easing. So what happened is the Fed saw that, geez, it worked. Like we're seeing 20% price appreciation, and that's just not really good for anybody. So they hit the brakes and they stopped buying the mortgage-backed securities sometime in early 2022. Yep. And that's when the mortgage rates started to spike. And recently, actually starting in 23, they're selling MBS.
Right.
They're just not, when one mortgage gets paid off, they don't buy a mortgage on the market to replace it. They're letting it run off over time, which is a healthy way to unwind it. So if you think there's a chance of mortgage rates going from 6.7% back to 3%, it would be impossible unless you had the Federal Reserve get into another situation where they thought it would be practical to buy $3 or $4 trillion worth of mortgage-backed securities in a very short period. Without that, that will never happen again. I don't know, Joe, did I explain that well?
You're spot on. And I think you hit the nail on the head. It is not going to happen again. Certainly in my career, maybe not in my lifetime, that we're going to see rates of 2% again, unless there's some sort of black swan, another pandemic or something. So if you have clients that are saying that's what they're waiting for, they're going to wait for a really, really long time.
Yeah, I just don't see it happening. So the thing to take away from slide 45 on the right-hand side is it's the risk differential, and it's gone from 1.5 to the historical range it's not quite as high as 3. It should be a little less than this, but not like a lot less. And you take that risk premium and you add it on to, I guess I don't have a 10-year treasury. What's the 10-year trading at? Like 3.5?
4.42 or so.
4.28 as of today.
Got it. So the risk premium must be trending down a little bit.
A little bit, yeah.
Yeah. So either one of these things can happen. If the 10-year goes down, the mortgage rate will go down, or if the risk premium goes down, you'll see the mortgage rate go down. So mortgage rates are going down now, partially because they're perceived as a little bit less risky. That's why you see this risk premium going down, but it's more because the 10-year treasury is going down. And that's actually not all that great. It's going down because the market thinks we're going to have a recession. And historically, when there's a recession, what does the Federal Reserve have to do? Lower rates. And what does the market usually do? They accept lower rates. And Joe, is that kind of the real driver of why we're seeing this mortgage relief?
Yeah, you're spot on. There's talks of a recession coming, and I think it's possible. And recessions generally lead to lower short-term and lower long-term rates. And as rates come down, the biggest risk on this chart on the right is prepayment, right? Prepayment speed is the biggest risk. It's not foreclosure risk, but that loan paying off early. So as the
Can you describe what that is? Let's
Yeah.
pretend I bought a house last year and I'm at 7.25%, and you call me 3 months from now and say that you could get me a loan at 6%. What happens?
Yeah, so there's no prepayment penalty, right? So you can pay off that loan at any time. And when, a mortgage-backed security buyer, when they bought your loan, they were expecting to receive 7.5%, generally for a 7-year period, right? Because no loan stays for 30 years. Well, all of a sudden, rates go down, you refinance, they only made that 7.5% for maybe 3 months or 6 months. So they made a heck of a lot less money. So when interest rates have a big run up like this, the premium goes up, that the mortgage-backed security buyers want to make more money earlier in the loan to make up for that risk that you're going to refinance in a year or 2 years or 3 years. So as the 10-year treasury comes down, you'll see that prepayment risk come down a little bit with it, and that's going to lead to improved interest rates. But all of that is predicated on having a recession.
So the long and short of it is I think that rates could probably drop a little bit more, but not a lot. They've already actually dropped more than I thought they would all year. I mean, Joe, is that kind of what are you thinking?
That's exactly. So really early on,
I didn't expect a recession either until we
right. Yeah. Really early on, I talked about the experts are predicting that rates will go down between 3/4 and 1.25 point. And you and I think we're going to be between 1/4 and 1/2. So far, we're about right. It's been right around 0.5 point of improvement. But if things continue to improve further, you and I are going to be wrong. But that's a wrong that I'll happily accept.
Yeah, I'll take it.
Are right.
No doubt. So, well, here's the 10-year.
Oh, there it is. Yep.
So you can see the 10-year since the beginning of the year has gone from 4.8 to 4.4. I think it's actually a little bit less than that now, even.
Yeah, 4.28 today.
Yeah, so this chart is like 3 weeks out of date. So historically, the 10-year will drop about 1.25 to 1.5 from the top of the cycle. So if you take a look at 4.8, when you get to a recession, could it get to 3.6? Historically, that would be true. That seems like a lot, but yeah, I don't know. It seems like a lot.
That seems like a lot to me.
I could say half of that. I mean, I could see it going to like 4.
Yeah.
Maybe 3.8.
Yeah,
we'll see.
That would be exciting. We'd be busy if that happened.
Oh my gosh.
What do you guys think was happening, around that September timeframe or leading up to the September 2024 timeframe when the 10-year dipped all the way down to 3.6? Because since then we've seen nearly 120 basis point swing, at least up to that 4.8 mark. Now it's back down to 4.2, but that's a pretty significant move in a relatively.
We have to go back to the Wall Street Journal headlines like in late August and early September, and if you just looked at like literally just the front page for 10 days, you'd find the answer.
Oh, okay.
I don't recall now what drove that then.
I believe it was a little bit of non-headline economic stimulus and pressure leading up to the election. And then,
well, that's what it was.
Yep. If you guys remember my prediction that I posted 6 months ago,
rates will go up
after presidential elections.
Always.
Rates go up 100% of the time.
They did.
Yep.
They went up a lot, and they always do. Like your history showed it. Like in 16 of the 17 last elections or something.
I don't recall anybody calling me and telling me I did a good job on that prediction, but I'm sure
nobody ever thanks the economists when they're
I'm
right.
sure my thank you note's in the mail.
One of the hazards of the job. So this is a parting thought that I want you guys to think about with your clients. So in 1971, the interest rate went to 7.3%, which was considered an outrage at the time. Yep. So all the clients of the realtors in 1971 said, I'm not going to buy a house till rates are like 6.5. I'm not going to pay that. And you would have waited 22 years for that to happen. And meanwhile, the value of real estate when you were waiting quadrupled. So waiting for a lower rate isn't always the best strategy.
I agree.
You can always refinance.
That's right.
It's always an option. Do increasing rates impact the market? Yes, they slow things down quite a bit. So you can see that the overall rate of appreciation has slowed down quite a bit since the rates started going up. So no surprise there. Also, increasing mortgage rates predict lower sales volume historically. It's like almost a perfect correlation. So the sales volume last year was like a 30-year average or something, lowest that had been in the last 30 years. And if you adjust it for per capita, because our country's a lot bigger now than it was 30 years ago, like it's like triply abysmal. So this recent relief in rates will probably help us out a lot.
I agree.
So interestingly, we were having a problem through the winter and January that there was a lot of new inventory coming on the market, which is really great for buyers, but the buyers weren't excited about purchasing because the rates were still kind of high. And just the general negative economic sentiment out there, which I assume you guys probably talked about at the very beginning of the broadcast here. So a lot of homes are getting withdrawn. So, nothing like 2007, 2008, but if you take a look at the historical trend over the last 5 or 7 years for homes getting withdrawn, like it's high.
It's high.
So
there's a lot of homes that don't sell during that first 90-day listing contract period or 180 days. We're seeing
much more than normal.
Yeah.
So the message for you guys who are on the call who are realtors is that if you're going to take a listing right now, more than usual, it's really important that it's priced competitively relative to its condition. And if you've got a seller that's not able or not willing to do the renovations to make it look good, and they're not willing to adjust the price, the odds are not in your favor for getting this thing sold. And that's always true, right? Like, I'm not telling you anything you already know, but like you've turned the dial like several degrees more than you normally would. So just be aware of that. This is a pretty important set of messages to get across to people.
That's right.
So this chart, Joe, I thought was really interesting. So the chart, the light green shows you the people who are paying more than 6% for their mortgage. So between 20 and 22, of course, it was like on a really steep downward trend because we had all these 3% loans. And then in the first quarter of 22, that's when the rates went up. So we've been making all these over 6% loans for the last 2.5 years now, 3 years almost. But I thought that the people who had these loans for less than 3% was like, a huge number, like 80% of the people, but it's not. It's
right.
like it got to like 33% of the people had this really cheap rate below 3. But that's not nowhere close to everybody. And you can see it's like dropped a lot really quick.
So
can you tell us about this?
Yeah, we touched on this before you joined on the initial summary of the lock-in effect. When that dark line peaks, the less than 3%, it peaks in 22. We had so many people, and I still hear this, I have a 3% mortgage, I'm never selling my house. If that sentence were true, this dark line would not decline.
It'd be static.
It would be static and it would stay flat. So the fact that it's not true means that your mortgage interest rate is not the only driver of whether or not you're going to sell your home. Births happen, deaths happen, marriages happen, divorces happen, job relocations. And that's exactly what we're seeing is people are buying and selling homes for all the reasons that they've always bought and sold homes. Life goes on. And so that lock-in effect is easing up, which is, I think, a good thing. If you've got a 3% mortgage, obviously you love it. But as a real estate agent on the call, it helps to have not as many folks locked into a low rate.
Absolutely. So when we talk about how we're seeing more listings come to market, it's because the lock-in effect is attenuating over time, which you would expect. It's happening faster than I expected. Like if we were just to take this current heavy dark line at the top, we've gone from 35 to 25 over the course of 36 months?
3 years, yeah.
Could we expect like in another 3 years, like it'll be at like 18%?
It's kind of what I think. What I think will happen is this will settle somewhere between 15 and 18%. And then we'll see who are the folks that really are never going to sell their home because of a 3% rate. And then we're going to see that static line, at 15 to 18%. And there will be certain people that is true for, but a lot of people, they're going to sell because life goes on.
What I'd love to know, and there's probably absolutely no way to get this data, is of the 25% of the people enjoying those mortgages for less than 3%, how many of them have got like the $1 trillion credit card balance we talked about earlier, and they're going to have to refinance? Not because they want to, they've got this really great rate, but because they have to.
The answer is a lot.
Yeah, so that might be providing extra pressure right now to push down this green line. And the faster that line gets to zero, the more fluid our entire market is going to be. And you won't be hearing this bullshit all the time about I'm at a 3%, I'm not going to sell, like, because there won't be any of them left. They'll all be extinct.
There's something about the powerful, like, F-bomb or, curse word that you drop in that just gets everybody's attention.
Yes, it's just so frustrating, having a brokerage with 700 guys out there just trying to sell a house, and the excuses we get are just so frustrating. Like, let's get a deal done, people.
Yep.
All right. So, Joe, do you want to tell us about these charts? These are just such fun charts.
Yeah. So the one on the far left, this is the purchase index, which is purchase applications. So the line you want to look at is the dark blue line that's in the bottom left. And you see that purchase applications were at an all-time low through the first few weeks of this year. And we've just barely last week had more purchase applications than we did the same week in 2024. So if you feel like there's just not a lot of activity out there, you're not getting a lot of showings, you don't have a lot of buyer traffic, this is it. There's just not a lot happening for all of the reasons we've touched on: affordability, lock-in effect, et cetera, et cetera. There's just not a lot going on as compared to the last 10 years. And then the chart on the right is people locking in their interest rate. And so what I think is really interesting is the dark black line has not eclipsed the 2024 line yet. So if you compare the left, there's more people applying and getting pre-approved, but on the right, there's not as many people getting under contract. And I think that's a function of buyers have a little bit more choice. They have a little bit more negotiation power, and they're a little bit more fussy right now. So you would expect these two lines to correlate almost perfectly, but the one on the right trails by about 30 or 60 days, but we're not quite seeing that. So we're seeing people get pre-approved, but they're a little more picky about what they're buying, which goes back several slides. If you're selling a property, you want to make sure it's parade ready, because your buyer, your potential buyer, has options. Your house is not the only one in today's market.
Yep, there's an awful lot out there for sure. It's just, you can tell so much with that story. This is sort of the counterweight to that for people who've already got their house. Maybe with a 3% mortgage, maybe not, but they're having to refinance because getting a second mortgage for whatever set of reasons isn't the right answer for them. And now they're going to be reset to today's rate of 6.7% or whatever. And the number of people doing that is that in thousands?
So the question that I have on this, Lon, and I don't know if we would be able to find out about this or not, I wonder if this refinance index includes second mortgage applications.
I
think it does, because our refinance application has picked up, but it's been a lot of either cash outs or mostly second mortgages, because a second mortgage technically is a refi. So I think this includes second mortgage statistics.
Regardless, everybody on here is breaking their piggy bank, taking equity out of their house.
Yes.
For one reason or another. It doesn't necessarily affect the lock-in rate as dramatically as we might have thought, but It's good to know. So earlier we were alluding to there's more houses on the market. The buyers aren't excited. That translates into showings. And you can see the showing traffic isn't quite as robust this year as it has been in prior years. You can take a look at the green lines at the top, 2021 and 2020, where the COVID mania. So, obviously we're never going to see showing traffic like that ever again. But the pre-COVID average there is probably the right benchmark for us to think about, the dashed blue line. And we're running about 40% off of what that rate is.
Yep. Well, cool. Well, thank you guys all for joining us. Lon, Nick, I really enjoy these. Always really grateful for you guys' time and your expertise. And Lon, I love the new charts you've added in here. We talk about it a lot, that this packet gets bigger and bigger, but I think it's all good data. And I went through, there wasn't a single thing that I would have taken out. So, I really appreciate the time and energy that you put into this.
I'm delighted to do it. I'm so honored to get to do it with you guys. And thank you for the dozens of you guys who are on this. I really appreciate it. Thank you.
Oh, and
thanks, everybody.
One last thing I will share with everybody. Our new book, How Real Estate Agents Can Succeed with AI. Lana, put one of these on your desk. This is our proof copy. So this will be out in about a month. So if you're a real estate agent, make sure you keep an eye on the calendar and the way you got invited to this, because we're going to be doing our webinar on, I think, April 17th for real estate agents, promoting our new book on how you can use AI to grow your business. So we're really excited about that. We're going to have a lot of classes on that topic as well. So Lon, you've done a ton of work on that as well.
So did you.
We both did a lot, but everybody on the call, make sure you're watching out for those emails because I think it'll be a good addition to your business.
Super. Thanks, everybody. Have a great night.
See you, everybody.